So it is kind of interesting since Kevin Warsh's name was announced as the new Fed chair, nominated by President Trump. Markets have basically been falling. Stocks have been falling, mostly techie stocks. Gold's down, silver's down, Bitcoin's down. So let's talk about it. We welcome Phil Kerpen, Unleash Prosperity Principal, and Mohamed El-Erian, Allianz Chief Economic Advisor. Gentlemen, thank you. So, Mohamed, maybe it's just a coincidence, but should I read anything in? Gold down, silver down, so precious metals are down, and stocks are down. They're not down a lot. We're still, I think, in bull markets, but nonetheless, and Bitcoin's down a lot. What do you make of it? Or is there anything to make of it at all?
So I don't think this is a Kevin Warsh story, Larry. This is a story about a market that saw incredible gains, led mainly by institutional investors. It attracted lots of tourist investors, speculators. And when the institutional investors started rotating out of the few names that had done really well into something else, the speculators got out. And we are seeing a very technical-driven sell-off right now. And you see it in Bitcoin, you see it in silver, you see it in tech, you see it in the most speculative areas of the market.
So this could be a good thing, right? I mean, every now and then you got to have a little cleansing.
Yes, I think of it as a cleansing. I also think it's going to provide opportunities, but rather than invest in themes, like last year, everybody fell in love with AI. It's really just a handful of names that are going to do well. And there's other areas of the economy that are benefiting tremendously from the high growth that we are seeing.
Phil Kerpen, let me come to you on it. It's a different subject, but one of Kevin Warsh's goals, and he said this many times and he's written, he wants to get rid of the Fed models, you know, that prosperity and economic growth causes inflation. He wants to get rid of QE, and I say good for him on that. He also likes to watch market prices, okay, instead of these old moribund Fed models. And it includes commodities. So we're going to put up on the chart commodity metals, all right, CRB metals index, we'll put it up on the full screen, is showing a very significant rally. You can see the upturn in that thing, and there's no correction there. And actually, the CRB futures overall there's the CRB spot. That thing is also, we'll put on this, yeah, you'll see the overall index is also looking strong. So let me ask you this. I mean, if those commodity indexes, which Kevin Warsh is looking at, they're forward-looking price indicators, sensitive price indicators. I think he's 100% right. Is that telling us that we don't need lower interest rates, or that lower interest rates might even be a bad idea, an inflationary idea?
Well, Larry, I think that, at the same time we've got a lot of these commodities that are rising in price, we've also got the decline in things like gold. Oil is still at a very low level. And so it's a little bit of a mixed basket. It's a little bit of a mixed picture right now. But I think what you're going to get with Warsh may be something like a synthetic price rule, where they look at all the commodities and they try to, in a forward-looking way, tune their policy towards limiting inflation, rather than, as you pointed out, the incorrect assumption that economic growth is going to be per se inflationary. So I think if they do move in a more rule-based direction, then market participants will be able to look at the same indicators the Fed is looking at and have a good indication of which way they're going. But I think this is all going to be part of what he explains when he goes to his Senate hearings and how he's going to operate the Fed.
I mean, Mohamed, I like the idea of looking at these forward-looking indicators and these market-sensitive indicators, and they happen to be inflation-sensitive indicators. Do you have a thought on this? I mean, metals are rallying. It may not be inflationary. The rally in metals may be strong growth, or it may have something to do with AI data centers. Who knows? It may not be. Gold and silver, which are traditional inflation indicators, as you noted before, the bloom is off the rose on those. But anyway, how about bonds? Bonds, the bonds are an indicator of future inflation. The CPI break-evens and the TIPS market, all of those things would probably be a welcome change. What do you think?
So first, I think the bond market is well behaved. I think that the metals that you're talking about are a reflection of strong growth. As you said earlier in the show, the US economy is growing at an astonishing 4 to 5%. That's more than double what Europe is seeing, just to put in context. I think what Kevin Warsh stresses, which is really important, and you and I, Larry, have talked about this, is he believes that we're on the verge of a productivity boom, that boom will increase the safe speed of growth, meaning the non-inflationary growth, which will allow interest rates to come down. This is a very important change because this Fed, which made huge mistakes, has been overly data dependent, backward looking, and we now have a nominee who's willing to look forward again, just like Greenspan did at a very important time in our economy.
You know, Phil Kerpen, on all this, one commodity that's come down, now it fluctuates vis-a-vis the Iranian possibilities of perhaps conflict, additional conflict in Iran. But energy prices on the whole have come down over the last year or so. They've come down about 20–25%. So that's an offset, Phil Kerpen. And I think you have to take it, you know, metals are doing this, precious metals are coming down, industrial metals are going up, energy is coming down. You kind of have to figure out the whole picture. And it will be interesting to see how Kevin Warsh puts that picture together.
Yeah, absolutely. As I was saying, it is a mixed picture. We certainly have things that are up and things that are down. Even within energy, most places we've got electricity up and we've got oil and gas way down. So it depends on kind of how you look at that basket. But we are in a huge productivity boom. I agree with that. And that really does change the rules of the economy. Nobody knows how much AI and these other new emerging technologies are going to really boost productivity on a permanent basis. But it could be a stepwise increase again. And I think that's why you're seeing the growth potential of the economy really increase over the past year.
I'll tell you one thing, Mohamed, give you the last word. If he gets rid of QE, QT, any of the Qs, I would be very happy. I would welcome that. He says he's going to get rid of them.
I would too, Larry. I think we got carried away with QE. We distorted markets. We're now finding it difficult to get out of the markets we've distorted. And you and I know that when we distort market, we also distort the allocation of resources. So I'm glad we've got someone who's more level-headed and understands that the Fed should be operating on a smaller playing field and stop this mission creep that we have seen for the last 8 years.
Yeah, couldn't agree more. And that's what he wants to do. I look forward to his hearings and for the Senate. Anyway, Phil Kerpen.